Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we want to talk about the dump on Bitcoin. And while we had hoped that we would put in another formation similar to the one that we had on the higher level up, as capitulation does intensify on the Bitcoin chart, we are just seeing these eras of sideways action contracting smaller and smaller. This one appears to be about 1/3 of the size of the one before it, and this one is about half the size, maybe even less than the one before it. And so we are seeing a shrinking in the sideways action, and we're not really getting the amount of play that we used to be getting in terms of trading ranges. So, unfortunately, that did invalidate the setup that we were talking about in the last episode, where, hopefully we would have put in a similar formation as this one, gotten some positive PCE data, had a nice pump, and then perhaps unwound as maybe the CPI data came in next, which then would either send us down or back up for a kind of relief rally. In this case, the CPI data was very negative, and so it did drop us to hell. But the PCE data that was released over here actually ended up being positive, and so it saved us from dropping off of a cliff. You see this little wick here. Unfortunately, that was not the case this time. And in our current level, what ended up happening is that the market front ran the positive PCE data. And so during the middle of the night last night, before the PCE data was released, whales and other institutions just dropped their Bitcoin off in order to de-risk from the market. Of course, last episode I was telling you guys that Cypherpunks was going to de-risk and get rid of their Bitcoin and Ethereum, and you may be seeing that pressure on the market where there's now more supply and there's just not that much demand. You guys know the demand zone that I have in my mind for Bitcoin, which is really in that $14,000 to $11,000 range. Prices that people thought were unthinkable. When I first started making this channel, but of course I've stuck to my guns and I've just always said we are likely to break 25K, likely to break 20K, and that the targeted range that I would really be looking at is this 14,000 to 11,000 in terms of offering us some real support. And then most likely, if the economy continues to be just corrective in terms of the couple years of money printing that just happened during the COVID era, when all the administrations around the world were just printing dollars. Then of course we could be thinking about even these levels between 10,000 to 5,000, where some of these areas could be pretty juicy for Bitcoin to target as well. And so, guys, I just don't think that this is over. I've been telling you since the very beginning of this show that there would be downward pressures. I've showed you the macro cycles in the stock market and how that's going to impact crypto. And from bitcoins to altcoins, everything is just going to be retracing the gains that they made with that money printing ever since basically the middle of the Trump administration, when the money printer just went onto maximum overdrive, and there was literally no accountability for any of that money, no accountability whatsoever. I'm sure we have no idea where that $5 trillion went. It literally just went into corrupt pockets. It went into stimmies. It went into crypto. It went into the stock market. We have no idea where it went. And since it was free money, and then on top of that, almost infinite free loans, which loans themselves, private loans, contribute to the money supply, which makes money worth less because there's more money, because you've gotten a business loan, you've gotten a personal loan, you've gotten a credit card loan, all of these businesses taking millions of dollars of loans, and then the monetary supply increases, money becomes worth less, inflation happens, and then to fight inflation, you have to increase interest rates, get those loans to be reduced, and then the money supply contracts as there's fewer loans out there. Of course, businesses cannot expand as fast because they're not getting free money, they're not getting loans because the increase of interest rates are making it harder and harder. And so you do see some contraction in GDP, you see contraction in business. In some cases, some companies may not be as able to hire as much as they would like because they're not getting basically free money printed from the government, in the form of private loans via the Federal Reserve policies, right? And so they can't get those, employees basically for free and make new departments, which is why we have a glut of jobs right now. And right now it's okay. Like we're in a fine balance. It's okay to have inflation for a little while, but we really don't want this to continue for much longer. It will choke the general population. And so, we will have to continue fighting inflation for quite a while. And that should be the national and perhaps even global focus this year. And so we would consider that these assets will continue to depreciate. But that doesn't mean that we couldn't get a bounce along the way. And so, it's okay to be hopeful. It is okay to take some trades. But when your principles get violated, then you do have to step back and maybe not take a trade. So even though I was suggesting that we could have this pump due to the PCE data as long as we held the floor, there were several conditions that I personally put on that trade in terms of having standards. The first standard was that we could not break below 19,000, 600, 19,500-ish, and we did break that neckline. When we broke that neckline, the trade setup was invalidated. We had to hold the floor, have a higher low, higher load, and then have a chance to pump from there. Sort of like here, we wicked down, but we didn't violate the previous low. Since we did violate this previous range low, it was just a very bad sign that we would likely to continue down. Additionally, although we did have quite a kind of a bearish distributive triangle here, one thing that we had going against us in this particular setup was this Adam and Eve, this inverted Adam and Eve formation here, where the measured move was to the downside. And I actually gave a pretty strong warning about this in my friends group yesterday in the early morning. And, one of my friends in the group, of course, he had noticed it too. And so we had a couple eyes on this one, and we suggested that it could potentially drop us down to 19,000. And if we did get a bounce, maybe you would retest the neckline at most, but that would be a limiter on us if we did end up breaking down from this formation. And sure enough, we did. So that Adam and Eve formation is actually carrying out. And the whales, the Bitcoin whales and the institutions knew that this was the setup that was being put into play. And so they did take advantage of it last night, even though the PCE data was in fact bullish. If we look at the PCE data, you can see that core inflation actually only increased, 0.3%. The expectation was 0.4. The core PCE inflation year over year, previous one was monthly, was a 4.7%. The expectation was 4.8%. So guys, like we're making progress on inflation. Like whatever the Federal Reserve is doing, they're doing their job and it's actually working. But the problem is that, of course, that doesn't mean that every asset is going to respond. And once you're already in that kind of capitulation kind of setup on the charts, where you're just basically reclaiming this huge candle over here, on the perhaps like a 3 month or whatnot. It's just going to retrace down. This is not a lot of support. That previous all-time high is not a lot of support. This little wick right here is not a lot of support. And so where we have support is down here in the body of the price action. And so I would at least expect, you know, I mean, if we get a bounce, maybe 14, and then some type of hang up, maybe around 12, and then maybe the first real catch, I think, could be in that $11,000 area. And then you might be even counting on, 10,000 to 9,000. And in just an extreme circumstance, then maybe that 5,000 to $7,000 area where we do have, these kind of like supply zones. And so if we do just continue down, we have quite a ways to go. And now that it's basically a straight line, who's going to come in to be a buyer, right? That's the question. Like, who's buying? Buyers, if you're out there, please respond with a nice relief rally, but they're not coming, right? And so again, like we really do have to pay attention to our trade setups if we're going to be taking any type of a long position in a downward market. You guys should primarily be considering how to short. And if we do have the potential to pump sort of like we did it up here also, right? Like you can see this type of, kind of wedge here, and then we had a nice pump up here, right? Sort of like this one, right? This kind of wedge, and then we had a pump. It was logical to consider that we might have had a chance for a pump at least to the top of our range. Now, the guys who were saying that, we were going to go to $28,000 most likely, that was highly dubious. I mean, it was very unlikely that we were going to get there. But a trade to the top of the range, given the previous behavior of Bitcoin during this downturn, was quite reasonable. And simply, we did get front run by the whales and the institutions who are under pressure to sell, not to buy, because they are facing basically extinction at this point, and a lot of them are below their original purchase prices because maybe they started their businesses up here, right? And so, they are just underwater in many cases, especially these DeFi projects that have been coming online during this period. They are just underwater and they don't know what to do except to sell. And that's why this is capitulation. We have not capitulated. I just want to make it clear. That's the difference of language. We have not capitulated, but we are, in fact, in capitulation, and no one can disagree with that. I mean, we have been capitulating ever since basically, I mean, I would say ever since here, but you could argue here or here, but at least this whole range has been part of the capitulation process. We lost, we lost our support here, and then we retested it, and we have just been breaking down basically in a straight line. So, guys, this is not over. There is a lot more pain in the market, and although we had a chance for a pump, we got front run. I like how my friend Retta says, Crypto Retta, he says that these institutions are basically being forced into it. Okay, like they don't have a choice. This is no longer about them trying to liquidate you. It's basically institutions trying to liquidate each other, and so these are forced liquidations, right? These are fire sales. These companies are going to be going out of business. Their dev teams and their people are going to be losing their jobs, and so they have to sell. They don't have a choice, and so this isn't to screw you over. Whereas in the healthy market, a lot of that price action really is to liquidate you. In this case, it really is just the institutions trying to liquidate each other and trying to get out of the market with whatever they can before things turn even more sour. And so what would I expect from here? Well, there is the possibility, in these type of, Adam and Eve formations, sometimes you get this type of V and then you get the cup and, there's a neckline. You break down to the measured move and then sometimes you come back up and test the breakout as resistance and then continue your way down so that it's an overall bearish pattern. However, we might not get the momentum, that positive momentum to retest the neckline. So I wouldn't necessarily count on breaking up to 20K. But if we did, then of course, most likely it would just act as resistance and we would continue to break down after that. But we'll have to take it level by level at this point because you just can't look 2 moves in advance anymore. It used to be that you could do that, but we are now just in such a tenuous situation that we will have to take every single level just level by level. And of course, there was another reason why, which I did warn you about in the last episode, that there was the potential that we could break down, and why I didn't take that long trade setup that I had in mind, because sometimes the best trade is not to be trading if you don't have perfect conditions and if you don't stick to your standards. The standards that I had was that the Stokes, you can see that it kind of bottomed out here. It had to be pointed in the upward direction, right? Both of the moving averages on the Stokes had to be pointed in the upward direction, while the volatility was expanding, or pardon me, contracting in a corrective move. And the problem is that the Stokes ended up continuing to be pointed in the downside direction while we were getting that contraction. And so it did suggest that we didn't have the proper setup for a long. And so I did not go long, even though I had called the trade setup as an analogy to this previous level. I did not enter that trade. And so I didn't even have to use that stop loss at 19,500. The validation that I set was, in fact, you know, that we had to break that we had to break 20,500 in order to take that trade. And since our price action, if we go ahead and go to perhaps the 4 hour, our price action never got above 2,000 or 20,400. The price that we needed to meet was a candle close above that 20,400, and what I was suggesting to the group was 20,500. We had to close a candle there, preferably a 4 hour candle, and then perhaps this trade would be the logical trade to set up, because that would have turned the Stokes positive and that volatility could have sent us in the upward direction. But as it was, we ended up breaking down from this diagonal essentially. We closed the candle in this area down here around 20,000, and the volatility ended up contracting to the downside. That's why I didn't need to wait until we broke under 19,500 to know I'm not going to take this trade. Simply, we never had confirmation of bullishness. And you guys can sometimes take trades on support early on, but when it gets a little bit late in a formation, there's a good chance that they're going to break to the upside or to the downside, and you're going to want to wait for confirmations if you haven't already, played the more obvious moves when there's a lot more um, when the market structure is still being sort of tested in a healthy way. When you get to the extremes of the formation, like this triangle was almost played out, you really want to have very solid confirmations with significant candle closes if you're going to front run the move. Otherwise, you could get a nasty surprise. You could wake up to a very nasty surprise, right? And that's also why you would want to have your stop losses if you did take that play, because if you went to bed, you wouldn't want to have lost more than the range low there, right? But again, guys, like there was two setups. There was the potential for the PCE pump, and then there was the potential for the Adam and Eve drop. And we did get the short scenario. So congratulations to anyone who took that setup. But in my case, I just decided to stay out of the market. Jumping over to stocks, we can see, of course, that stocks are considering to retest their lows in their range. Nothing too exciting going on here. We haven't broken below support on most of these stocks. We are just sort of exploring the bottom of the range. These are fairly bearish retraces. We could continue to just be breaking down here. We're looking at the S&Ps, the various S&P indices, and we still have those CME gaps up here that we could potentially pump to, but most likely we're just going to continue in a downward posture. The market really is not responding positively to the PCE data. I think they just realized that this is going to be a long haul. And if we do end up getting some type of relief rally, maybe we just need to, we need to just catch people a little bit more by surprise. Sometimes these things just don't happen when the market really wants it to happen. And so if it was kind of an obvious move because of that previous reaction up here or perhaps right here, then maybe the market just decided not to take it. Additionally, I think the stock markets are also coming to terms with the fact that they are capitulating. It's not just it's not just a healthy pullback in the market, but this is kind of a macro capitulation going on here on a huge macro cycle. And so there could be a significant amount of downside. And because of that, who wants to buy here really? Who wants to buy here? We're going to have to wait to see if the buyers step up and if there's going to be some type of reaction rally. Generally speaking, these type of first moves are put in by retail. So retail would have to decide that that they're going to take a risk on some type of value, like that they see value in these prices of perhaps Tesla or Netflix or Apple or whatnot, and that they want to front run the market. And then the market makers will get in and they'll probably just pump it to a high heaven, and then they're going to dump all on retail's heads, right? But of course everyone is getting more sophisticated, and so it is possible that we do just continue dropping pretty sharply in capitulation all the way down, perhaps to my trend line, or perhaps some type of like a middle area somewhere around there, kind of like the this kind of golden pocket, perhaps just a little bit further to drop, or doing the full retrace without any significant stop, sort of like what happened in COVID. And of course, it will be quite scary, but it's just very possible, okay? It's very possible. So, like I mentioned, like how the market fakes you out, first they have the correction bottom where everyone talks about the potential pump, and then the sudden capitulation, right? The sudden capitulation. So be careful about those fake outs. And the motto of this channel, always be selling, always be taking your profit, and don't just hold these things, even if you think that you're buying a good value. If you do buy something at support, then quickly sell it at resistance and just put food on your table and, be a good trader, be a good little alpha monkey. We've been having a very good track record over here. And of course, not every setup that I've talked about has come to fruition. But the cool thing is that we're getting the invalidation points correct, right? You don't have to be correct in every trade. Like most of the trade setups that you find can potentially be invalidated. But what makes you a good trader versus a bad trader is whether you're able to recognize the invalidation points and the validation points and if you're able to distinguish that from just your greed or your fears, because of course I could have taken a trade to the downside or to the upside, for example, on Bitcoin yesterday, but I needed my validations to be met. And in case of the validation to the downside, I wanted to see us break $19,500. And of course, I was asleep at the time. And so, I didn't just want to be trading while asleep. So I couldn't have taken that short, but then my validation to the upside was $20,500 and holding that on a 4-hour candle, and that just didn't happen. And so the logical choice for me was just to not have a trade last night, even though I could see both setups, and both setups were equally valid until they reached an invalidation point, right? And then only the downside one ended up being validated. So again, guys, uh, have a plan, right? Know where you're going to take profits. Understand where these resistances may come, in play. And even if we do pump, just make sure that you take your profits at every resistance. Maybe you're using fibs, maybe you're using support and resistance lines on the weekly or perhaps the daily, or maybe you're using diagonals. It doesn't matter. Just make sure that you have a plan and that you're regularly taking that profit, because this market can potentially continue to be significantly punishing to the downside if we don't have a change in Fed policy. And what I do think is that if, going back to Bitcoin for a second, that if we do find just kind of a local bottom here, you can see what I had already been suggesting. I have had this drawn out for quite a while here, that most likely we would end up testing our range low, right? If we do end up finding support on one of these two levels, then potentially we could have that pump scenario if the CPI data is good and if the Fed changes its policy by not having a 75 basis points increase and instead having a 50 basis points increase. That could end up initiating that positive, pump to the upside, where if we just go over to the CME chart, the professional exchanges, and then check out volatility on the daily, then, when this move is kind of finished playing out, like whatever's going on right now, when this one ends up finished playing out, then perhaps we could get a pump to the upside as it reverses, assuming that we can turn the Stokes around to turn positive. And right now we need to recover 19,500. So that's a little bit of a stretch goal considering that we're under 19,000. It's going to be a little bit of a heroic move to get to 19,500 while we're still in potentially continuation to the downside in this kind of capitulation candle. But it is possible, and so you can think both ways, because you do want to, trade this market if you're not going to be holding it, and you don't want to just be completely out of the market. So you have to be thinking both ways. And again, like your downward setup might be validated or invalidated, and your upward setup might be validated or invalidated. But the key point is that you had a plan. It's not whether you're right or wrong, right? It's not whether you made a mistake or you didn't make a mistake. You're actually doing a really good job as long as you're sticking to your plan and using validations and invalidations. And there's a lot of different kind of woo in this market, in terms of like trading, where maybe you're trading this pattern or that pattern. In the end, it's all just price action. Whether you're using this indicator or that indicator, whether you're using diagonals or whether you're using horizontals, it doesn't matter. In the end, as long as your brain is developing an intuitive understanding of price action using whatever tools are best for you, using whatever trade strategies work best for you, and as long as you back test that and have shown that it has some reliability in how it plays out, then of course, just go for it and make your validations and invalidations, but don't make it something that you only think it must play out one way. Because this Adam and Eve pattern, it didn't have to just play out to the downside. It could easily have pumped just like we pumped up here, right? And, people were calling this one, an inverted head and shoulders. And so the measured move for that one would have been, like something like up here, right? Like 26,000. But again, like these patterns don't have to play out, and there's always another pattern, right? And so the key point of using these patterns is only that you can conceptualize the price action and that you can set up validations and invalidations. We don't have to think that there's anything magical about the price setups. And so again, whether you're using indicators, whether you're using pure price action, whether you're using patterns, whether you're using fractals like harmonics, whether you're using your own strategies, right? Again, diagonals or horizontals and supply and demand zones, which work really well, by the way. Um, you know, these things are just to guide you to setups that are pre-planned where you can visualize your profit taking points, where you can visualize your stop losses, and where you can create validations for the move and invalidations for the moves. And preferably, it's based upon some practice with that strategy before you put a significant amount of money in it. You don't want to just be throwing away your money in this market, because you do want to save your capital for when we finally capitulate, past tense. Even though we're in capitulation, we have not capitulated yet. And so when we do finally have capitulation and end up putting in some type of accumulation pattern for perhaps months, then you want to have all your capital ready so that you can just ride it to the upside, right? And if you ended up losing your money on the way down, that's not, that's not a great feeling, right? Unless you're an expert at shorting, you just want to be very cautious about what you're doing right now and just save your capital, maybe even get another job and just wait for that, accumulation pattern to be put in over weeks, over months. And you don't have to buy the very bottom ever. You can buy, um, a really hard confirmation with, macro EMAs, right, crossing over, right, and turning bullish, whereas they had turned bearish up here. You know, your EMAs on the macro might be turning bullish, and then you can buy in on those confirmations rather than just wasting your time, trading every single level if you're not good at it, if you don't have validations and invalidations, if you don't have a strategy that you've back tested. Okay, guys, just trying to get you guys to save your money and to understand that the opportunity will be coming up, but it'll just take time. You have to be patient, and whatever method you're using to target certain areas, they all seem to be overlapping pretty similarly. Even if we take our fibs here, let me get off the log chart. Even if we take our fibs, then we are entering those juicy levels around the 886, which tends to be a very juicy area for almost any asset that is doing kind of a full retrace, which would be that kind of $12,000 to $10,000 area. And just know that we could get front run if the market changes bullish suddenly, and that we could actually end up having a worse dip if things in the market get worse, right? Like let's say that the war with Russia in Ukraine stops early, then perhaps the market front runs and gets a little bullishness a little bit earlier. And let's say that the war with Russia or China and Taiwan, maybe some conflict expands there. then perhaps it could even be a deeper retrace than what you would expect. And so you guys want to have both scenarios, like whatever level, whatever area you're trading, you want to have, kind of two options, think two ways at any one time, and that will really help train you to use validations and invalidations as opposed to just believing that something must occur, right? Because it doesn't have to occur. It's just possible. These are just possibilities and probabilities. Okay, guys, sorry that I can't give you more of a market direction. The market is probably just going to be digesting whatever the Federal Reserve might be doing next. They're going to try to, just determine, are they going to play the, the bearish sentiment down another level before perhaps we get a reaction rally? Are they just going to wait for the Fed's reaction, as everyone has just turned super bearish? The 6-month candle is going to be closing today, and you can see it's just an incredibly bearish engulfing candle. And you can see we've had these type of ones in the past. It doesn't really go well. It does tend to continue down. And so the reality may be hitting this market that we do have a ways to go down and that it could take a long time to recover. And so the buyers just may not show up. That, we may have an acceleration to the downside. You can see the top of this was kind of rounded, but then it was just, hugely accelerating to the downside in 2008. Whereas in 2000 to 2002, it was just a slow trickle down. We're going to find out which one we're actually putting in. And right now, it looks like it's probably going to be a hard capitulation. And, hopefully we don't have too deep of a recession in combination with this, because there are two separate things going on. The free money that was just completely injected into society, the pure money printing ever since the Trump administration, and that $5 trillion of printed, liquidity has just been overinflating the stock market. It's been overinflating the economy. And so things are just very expensive right now. That's one issue, fighting inflation, where the Biden administration's policies is to fight inflation so that we don't have hyperinflation, so that the dollar can still be strong, and so that hopefully we can have a chance for another, super cycle where, the dollar is still the, the world's reserve currency. We don't want the dollar to die, but um, that's only one issue, right? The other issue is whether or not we are going to end up going into recession, as all of these, supply chain issues, from China to Russia to even the U.S. and Europe, as we've just kind of gone back and forth through these different COVID policies and these different shutdowns and stuff, a lot of them which have been tragedies for business. Um, we have to see how this impacts the market as they try to make these kind of industrial changes to their supply chains in an era where liquidity is being cut off. And why do I mention this? Because while we're fighting inflation, and that's absolutely necessary, it is absolutely the right thing to do, a lot of companies need liquidity in order to change their business operations, to shift from Russia and China to the United States or to Europe or to like other allied countries. They need money to change their operations from foreign oil to domestic oil. They need liquidity to change their operations from those kind of lockdown supply chains to, more liberally open, um, you know, uh, trade uh, markets where, people are back traveling and they're back doing things. And then at the same time, while we're fighting inflation, of course, this stuff is going to be contracting necessarily in order to fight inflation. but it's just going to put a lot of pressure on the economy, and that's why you can see the GDP shrinking, why you can see a lot of companies perhaps starting to trim some payrolls, even though we have 2 jobs for every person that wants a job. They're probably going to trim some of those excess jobs, and there probably won't be too much of a fuss over that until it gets to be less than 1 job available for uh, per person. 3 to 4% unemployment is pretty reasonable because people are always job switching. They're looking for other jobs, or they're temporarily out of the job market, but they're still looking, right? Because they intend to work. Maybe they're just taking, a month off or something like that in between jobs. And so 3 to 4% is pretty reasonable. But right now, we've just got way too many jobs. And so we are seeing corporations starting to trim jobs, which is a healthy thing to battle inflation. But at some point, we're going to feel the pinch if this continues too long. And then you're likely to see the Federal Reserve change policies temporarily. So let's see how sharp this is going to be, and just practice your trade setups, practice validations and invalidations, back test your trading strategies, and then keep an open mind to possible relief rallies, but always be taking your profits, always be selling, because there is likely to be more downside, and you do want to preserve your capital for when we do reach the bottom. And just remember, guys, you don't have to buy the absolute bottom. You can wait for the accumulation pattern, and then you can buy in, because you're still going to get a nice run after the accumulation pattern. You don't have to buy the absolute bottom. You can buy the confirmation of the bottom. Okay, that's your alpha for the day. Stay safe and happy trading.